Howdy, Team 42. It's your skipper here, Darius Dell, to present another episode of Pro to Pro Live. I'm joined with our friend and repeat guest, Cem Karsan, over at Kai Volatility Advisors. How you doing today, Jim?
Good. Great being here. It's been a while. Great to chat.
It is a lovely to have you, man. You're a fan favorite amongst our client base. You're a fan favorite pretty much on everybody's these days, man. You guys do great work over at Kai Volatility Advisors. But for those of us or those among us who have been sleeping under a very comfortable rock for the past few years, can you give us a little background on who you are and what you do at Kai Volatility?
Yeah, absolutely. So we run four hedge funds that are focused on non-correlated, performance, focused on the volatility markets, both trading volatility products, but also using the flows that come off the space for predictive analysis as well. So kind of what used to be a bit nichey, but now is really central to a lot of the day-to-day market performance as people are becoming more and more, clear with and beginning to see. My background is in market making. I had one of the biggest market making operations in equity vol land in the S&P 500 and other indexes back during the Great Financial Crisis and before.
That's awesome, man. Well, appreciate you, man. We'll definitely give you the opportunity to pitch your products towards the end. But let's just start with the great discussion we were about to have here. So in the prep, you and I were saying we're starting to have some divergent views here. We're still in the bullish camp here. We definitely, at least in terms of the most recent refresh of our quantitative risk management signals, are saying that, it's still pretty much blue skies ahead for the time being. That could change, obviously. And you're saying you're starting to see some things that are changing at the margin. So walk me through some of the things that you're seeing and kind of how you're thinking about markets.
Yeah. So, obviously we look at things a bit differently. We're very focused on short-term flows. We were out in front and November 1st in that big pivot, actually the decline that we saw into November 1st, and then the big reversal were things we highlighted. Even then we were we drew a big circle for people around January 17th, which is upcoming here, which is, expiration going to OPEX as a point that where a lot of those positive year end and beginning of year flows would kind of dissipate. Now those flows, which were very strong this year because we were in an up year, because there's very big open interest in on the put side of things broadly in December, these quarterly January OPEX. All of those things led to what we thought was high degree of predictability in terms of positive flows. A lot of that is now going to start being removed. So that doesn't mean we're going down in an aggressive way. It just means a lot of the positive performance we've seen, along with the pivot we saw from Powell initially, or at least perceived pivot, and a lot of the liquidity that we've seen come into the market from the performance really pushed a lot of that, and a lot of that comes off the table now. We're already starting to see the Fed walk things back a bit, right, in the last several days. Treasury still has to come to market as a election year, so there's going to be more likely spending on the way, and there's already plenty in the tank. So issuance is not going to slow down. If anything, going into end of year, Yellen had pulled back on duration, as well as slowed a little bit the issuance. Because again, it was end of year and there was still a lack of clarity when they announced those things about market action at the end of October. So we really see that issuance duration extending a bit, as well as a bit of a acceleration there. So you pair that with the Fed's kind of everybody's estimation of what the Fed was doing, kind of now being walked back from a pivot to something maybe just a pause. And then you pair that with all these flows that we talk so much about now being off the table. And, we think we likely get some mean reversion as a function of that. The supply and demand imbalance that there was going into this period now starts to reverse. And again, that really starts January 17th. Now, when I say starts, that doesn't mean, again, the day we're going to get that decline, right? I think, we've been drawing that circle out there for a while. A lot of people are now preparing for it, positioning for it. That has a reflexive effect as well. We have to be cognizant of that broadly. But our view is actually, and I'll be a little bit clearer here than I've been on other platforms up until this point, we believe that window opens January 17th. There is a window January 17th really till the end of the month. So call it, February, January 31st, February 1st. If we don't start to see that decline in that 2-week window, where flows are weaker, we would expect continued stability until then February of expiration, which I have to look at my calendar, but 14th or 15th, right in that window. I think it's the 14th, that Wednesday. That's when you would really, I think there's a higher probability of a continuation. So some chop back and forth during this period. If vol's well supplied, maybe just a small pullback, followed by again maybe a little run if we don't get some vol in this short window back to new highs. Could very, very well happen. But again, a lot of chop, vol compression. And at the end of that in February, then if we start to see vol increase in the market kind of go higher, I could see a Feb 14th reversal being the most likely. But again, January 17th, there's a little window here. And, I would definitely not be, aggressively bullish at this point. We have been very aggressively bullish since November 1st.
Yeah, no, that's how we share that date, my friend. That's when we made the pivot as well, for different reasons. We have a different process, but it's glad to see that, we were on the same side of the what has been a very profitable trade. And obviously you're thinking about looking towards the exits. You said a lot of things there that are worthy of unpacking, but before we even sort of go down the sort of the thesis rabbit hole, can you give us a sort of a more of a generalized sense of what you mean by the flows and how you're using them to kind of help predict market movements? Because some folks might not be as in tune.
Yeah. So in the options world, first of all, in underlying equity markets, one of the biggest drivers that people that don't understand kind of options and broad market structure miss is that a ton of the positioning that's happening in markets is not just long or short. It's not two-dimensional.
Mm-hmm.
People are betting on parts of the distribution, and the biggest carry trade in the equity market, that affects the whole market, and which has always been important, but has grown bigger and bigger, is selling of puts to buy calls. In some form or another. Again, that can be through structured products, that can be through just outright put selling. It can be all kinds of different reasons. Higher vol on puts relative to calls exists because the world has to hedge. In some form or another, there's a demand for downside protection, and that has been because the world is long. Whether it's your job or your assets or your business, that is how the hedging has to work. So you have a dramatic amount of skew, and that skew, much like other carry trades, leads to a market positioning, which is hedging that and trying to extract that yield. It's a great driver of edge throughout the market. So dealers, who are the ones that hedge that and manage and warehouse that risk, have to manage that. And over time, what that means is they're continually, in some form or another, buying back stock as it decays. But that's what's called charm, and buying back stock as the implied volatility compresses along the way as well. So those Vana, and that's called Vana. So Vana and charm flows happen. They're nonlinear. They happen as a function of a lack of movement and a compression of volatility, and they happen over certain windows. As you approach windows where there's a lot of issuance and a lot of this positioning that's warehoused by the market, and it gets digested, that buyback happens more aggressively in those windows, and that happens on a daily basis in certain windows, and it happens over the course of months and quarters, whatnot. So it's kind of inside baseball for those who don't play in that space, but a critical driver of market day-to-day action. I know most people focus on the fundamentals, to give a sense, during periods as we approach expiration, as we are now, these flows are often more than 50% of the supply and demand that's trading in the market. So a process, in our opinion, that does not take them into account is not a process for daily or weekly or even monthly prediction. Can you use other things that matter, more fundamental basis for multi-year prediction? Yes. But if you're really looking to predict monthly, even quarterly, a process without these flows is essentially missing 50% or more of the flows.
Yeah, 100%. I would tend to agree with that statement there. So let's walk through some of the, because obviously you do a tremendous amount of work on the fundamental side as well to sort of supplement a lot of what you do on the positioning and flow space. Are there any sort of, I guess, fundamental drivers or catalysts that can be paired with your expectation for things to maybe potentially start to head south here, or are you saying agnostic of that?
No, we definitely do, macro analysis and look at fundamentals. But I want to be clear, when we say fundamentals, what do we mean? I think that word gets tossed around. Macro gets tossed around a lot too.
Agreed.
The way we look at that is in a supply and demand lens, right? How is that fundamental kind of qualitative understanding of what's happening? Is the economy doing well? Are we doing more fiscal? Like, how are those things going to actually feed in to market demand? And measuring that piece is really what the piece you need to kind of focus on, in our opinion. You really need to be constantly thinking about where the rubber meets the road, and that is supply and demand in markets. If you're trying to do prediction on any period, again, less than, let's say, 2 years. And so the important fundamental, supply and demand drivers are liquidity. Like, what drives that liquidity? From a macro fundamental perspective, it's issuance, right? Like, how much debt is the U.S. the Treasury having to do to fund the government. That's a major driver, one of the biggest. What is the Fed doing? How is the Fed, going to meet those liquidity needs, and what are they doing in terms of different facilities or QT, QE, et cetera? Obviously, well understood liquidity part. It's not just here in the U.S., it's globally, right? So those liquidity drivers are, some people might just say those are flows. Those aren't fundamentals. Well, we kind of classify those as kind of these fundamental. They're offshoots of fundamentals, right? Those come about as a function of what's happening, fundamentally. Another one that's tied to fundamentals is stock buyback, right? What's happening with buybacks? What's happening, to earnings drives that, right? But it's not the only driver. It's also, that's a function of interest rates and other things as well. And so outside of that, what are some other things? Are there a lot of IPOs coming to business? Are there a lot of other things that are drawing from liquidity from the market? Otherwise, those are a function of what's happening in the economy and what's happening fundamentally as well. So these are all factors that draw upon liquidity or provide liquidity to the market. And those are things that we're constantly thinking about, looking at when we're looking at the bigger picture of supply and demand as well.
100%, man. Absolutely. So I got a couple charts I want to throw at you and get your opinion on, as it relates to, but at least we'll start with the flows and the issuance. Colin, if you throw slide 57 up here, where we just show the Treasury's net marketable borrowing as a ratio. The blue bars show the bills divided by the total, and the red lines are the coupons divided by the total. And we're showing it on a trailing 12-month basis. And if you look through Q1 of this year, we'll get the updated QRA in a couple of weeks here. Actually, in 3 weeks here. But if you look through Q1 24, which is what they projected in November, we still have this very anomalous setup where right around a third or just shy of a third of the total overall issuance is coupons. And so she continues to attack what I would consider to be excess demand for T-bills that is, sitting there in the RRP balance at about 600, let's call it 650 billion thereabouts. Do you see this dynamic changing at the margins? Or is this something that you think there's a secondary factor to consider here as it relates to financing?
Yeah. So part of our call in November, and this might have been related to yours as well, was not just the flows that we talked about from the vol space and end of the year kind of momentum reinvestment flows, but was tied to this. At the end of the year, given the market was weak in September and October, you enter a period of illiquidity in the market. And one of the last things that both Treasury and the Federal Reserve wanted is a kind of an illiquid period without well-supported markets. Mm-hmm. And so, given that decline, they really, and this we kind of expressed that this was likely, that both they and the Fed, in their own ways, really moved to on the margin support liquidity in the market. And again, it was on the margin, but those things matter. These are big numbers. And what the Treasury did is they moved again to the shorter end of the curve to draw upon the liquidity from the reverse repo and other places, where the liquidity existed. They didn't want a liquidity moment when people were trying to get bonds on the books at the end of the year. Right, that's the last time you want to be doing that. So they also on the margin again shortened a little bit, pulled back a little bit on issuance. I would expect that now that markets have come back again, policy is reflexive now that we're into the beginning of the year, now that bonds themselves, that have come down and yield, right? That there's likely to be an extension of duration, in that process. There's also likely to be just a slight acceleration, in my opinion, at this point. What the Treasury doesn't want to be doing, you have to remember, she works for Biden, Yellen works for Biden, and this is not a conspiracy. It's just the reality of the situation. She doesn't want issuance to be at its peak or accelerating into the end of the year near election season. And they're likely at this point now, that given that they were slow and a little behind the curve in terms of issuance, begin to move that back out incrementally. And so I would think those flows, if I was to put if we're going to predict whether those are going to increase or decrease, I think it's fair to say there's both duration and speed should increase here with the next QRA announcement.
Gotcha. Yeah, we would take the other view, respectfully. Obviously, it's what makes the market. In our opinion, we just don't see the need to do that yet. With about 650 billion in the RRP. Now, if this thing was a lot closer to zero, which we think it's headed towards zero back over time, which is where it tends to be for most of its time series history. Until there's really this, this not this obvious repository for T-bills in the marketplace. We think that this is good policy, and she should continue to do that, because at the bare minimum, it limits financial market volatility associated with dumping coupons and particularly bonds onto the market. And so I think in an election year, the more we go into this election year, the less likely it is that we're going to see her do anything that could be potentially costly from a market volatility standpoint. That's our view. We'll see if that holds.
Darius, quick question on that. I mean, don't you think that they would, given its election year, want to in particular make sure that they have room to protect against volatility later in the year, though? That's kind of why part of what I'm agreeing with you, that as we go later in the year, that they would want to not worry about volatility. And if they don't do things now, they will be that those balances will be near zero as we get to, they won't have dry powder as they get to the end.
Oh yeah, that's fair. I don't disagree with that. I definitely don't disagree with that. I mean, that $665 billion is still a tremendous amount of money. You know what I mean? Like in terms of the changing the entire issuance calendar, we probably, we could still be another 2 or 3 quarters out before that really has to materially impact it. But I see your point in terms of her wanting to potentially, kind of limit the impact later in the year as opposed to limiting the impact early in the year. Secondary question here. You mentioned stock buybacks are a tremendous amount of flows as well. So in this chart here on slide 42, Colin, we're showing our corporate profitability model overlay with the NIPR corporate profit growth. NIPR corporate profits on a year-over-year basis are in the blue line. The green, or the shaded area curve, shows our corporate profitability model, which is nominal, the spread between nominal gross domestic income minus the spread between unit labor cost growth and productivity growth. And what we found is that we were starting to recover pretty sharply in terms of this leading indicator for corporate profits. And in our opinion, I think we're probably going to see a better corporate profitability picture, at least over the next 1 to 2 quarters relative to consensus. And if that's the case, could we see some upside risk on buybacks that could cushion any sort of decline that we see in the markets in this window of weakness that you're identifying?
That's interesting. What do you think is driving that? And in your models, what I feel like I'm interviewing you here right now. I apologize. But this is what makes a good conversation is. What is the primary driver why does your model think that profitability is going to be better in the coming quarter relative to expectations?
Yeah. So it's 2 things. Well, one, it's 3 things really. Nominal gross domestic income growth has not slowed sharply, and it's unlikely to slow sharply. We continue to get leading evidence on that front. You look at the Atlanta Fed GDP now, you're not seeing a big drop off in sort of the growth of the economy. And then you have a continued slowdown in unit labor costs. And then we had a pretty sharp rise in productivity growth, and a big sharp rise in productivity growth with easy comps ahead. It's very unlikely that we see productivity growth, get back to the low, kind of negative numbers that we were mired in over the past couple of years in the context of, some of the rate cuts that we have already priced into the market and in the context of the, above trend fiscal spending that we continue to observe. Right now we're growing the G in the GDP report is currently growing at about 5% on a year-over-year basis. That's well north of its long-term trend. So in our opinion, there's a lot of good stuff happening underneath the surface in the economy that could, kind of surprise investors to the upside, particularly in the first half of the year, where I want to say GDP expectations for the sell side are somewhere around like 0.4 to 0.5, 0.6%. And so in our opinion, we think we could be moving through a two quarter period where growth expectations are surprised to the upside, earnings expectations are surprised to the upside, and ultimately stock buybacks are surprised to the upside. In our opinion, that it's obviously not bearish. It may not prevent the window of weakness you're highlighting, but we definitely want to flag it as something that's new, because we haven't seen anything like this in the last, let's call it 2 years.
What do you think is driving that greater growth?
Driving the improvement in productivity?
Yes.
Yeah, well, I think part of it is just the world. I mean, just fundamentally, I think the world is learning to live with this sort of hybrid work thing that we're all doing now. I think it probably took a couple of years post-COVID trying to figure out, okay, what's the right size for my labor force? Who needs to do what? How are we going to work here? And, what's the travel? What's all these other things? A lot of stuff changed in the economy in 2020 and in 2021 that probably just took, folks like me and you who run businesses a couple of years to adjust. And I think if that's the case, then I think we could be looking at a much better productivity environment on a go forward basis. I mean, it's very rare to see negative productivity growth in the United States economy. I mean, you typically only see it in recession. The long run mean of productivity growth is somewhere around 1.7%. If you look at the mean of the 10-year, 20-year, 30-year, 40-year, and 50-year averages.
Okay, fair. I think long term, this market ends up being, again, we've seen this for the last 2 years, but I think the economy has been dramatically, obviously, more resilient, right, than expectations, and I think that's partially because it's we're really fueling a demand side economic model, which is very different than what we've done in the past, call it 4 decades. And that has continued to support demand. That labor growth that you're seeing does continue to create more GDP strength than has been expected. So I would expect that broadly to happen. That said, I do think that there's a lag to interest rates, obviously, and the effects on the effect on economy. We are seeing a lot of leading indicators on our side, that are speaking towards a significant slowdown in the quarter ahead. I guess it's just a function of expectations at this point, and you have to wonder how much of that too is just the market rallying 15-20% in a couple months. If we're back down, you could see again a reversal of some of those trends too. So, but interesting to highlight.
Yeah, 100%, man, absolutely. So we got, as you might imagine, a boatload of questions from our audience here. So let me stop hogging your brain power and turn it over to the clients here. So our friend Brad is asking, Darius, you indicated a rising probability of a soft landing. Cem seems to be concerned with that the message is becoming consensus and therefore not likely to happen. Can you each of you elaborate?
Yeah, I'll dive in. I've been pretty clear about our long-term views, right? And our long-term views are, not too far away from soft landing and Goldilocks. It's actually, but it sounds much more nefarious, much worse. It's stagflation, right? One represents the best of both worlds. One represents the worst of both worlds, but they're very close to each other, actually.
Yeah.
My view is that we're in a very stagflationary environment, right? That we have we've gone from a structurally deflationary environment for big reasons, monetary policy driven, QE driven, low interest rate driven market structure, to the opposite, a wealth transfer populist push that is very inflationary, deglobalization that comes along with that, and protectionism. So all of these major trends, which we've been talking about for 3 years, which have only accelerated throughout this period, continue to create a structural underlying inflation. You see those in the numbers, right? If you look at labor, if you look at the places, in core, we're 3 years in and we're still seeing 4% core inflation that's driven by services, labor parts of inflation. Those aren't reversing. Those are going to continue to plot away at structural inflation. We are having to meet that with a tool that cannot meet that properly, which is trying to battle that secular inflation with cyclical, and that's what the Fed's doing by cranking interest rates higher and everything that it's doing. that can lower inflation in the short term from, like we did, from 10 down to 3, maybe even 2. But to get down to 2, the amount of pain that will have to be exerted on the cyclically on the economy, and the pivot that will eventually cause in monetary policy, that liquidity, when it does come back, will push inflation, in our opinion, dramatically higher. Very different than the old deflationary environment. So, as we get a recession, as things do slow, which we eventually will, they're going to keep pushing on this until kind of the inflation gets to where they want. And there is a lag, as we mentioned. That recession will be met with still relatively robust inflation, core inflation that may still be at 3.5%, maybe even still 4. And so I think that's one thing that people are forgetting. And I think the problem with that is that puts the Fed in a box. Right? Yeah. The Fed is in a very, very difficult situation there. They are not going to be able to stimulate like they have in the past. And the Fed put, which we've all become so reliant on and expect a certain reaction function from the Fed to exist, is not going to be able to exist to the extent it. And to the extent they do, they will drive significantly higher inflation going forward. And the risk is the second time around, if they drive a second bout of inflation, much like in the 70s, that's a really dangerous thing, because that's when they lose, control over the longer end of the curve. And if they lose control over the longer end of the curve, if we start to see a steepener, which I believe we will see in the year or two to come, you really begin to have an issue where that accelerates inflation. That forces the hand of the Fed and forces them to raise aggressively to lower the effects of people pulling forward demand, and also borrowing at low interest rates to buy anything pinned down. And those things will just, that will make inflation more entrenched and cause a much worse form of what we have. We've seen this. History tells us of these risks, and you can see all the clues underneath the hood, but we are continuing down this path despite everything we've talked about.
100%, man. I don't disagree with any of that from a longer term perspective. We've attacked the problem from a slightly different angle, particularly through the lens of our fourth turning analysis. This past fall, we did a empirical deep dive on the fourth turning and what that ultimately should mean for investor portfolios through the lens of policy, through the lens of some of these key economic dynamics. And one of the two main takeaways, Colin, if you throw up slide 71 here, is that real GDP growth tends to be relatively weak during fourth turnings, and you typically have relatively higher inflation during fourth turnings. And more importantly, inflation tends to spike. As you see, you go back and you pull the time series back far enough, you see that there's this consistent pattern of inflation spiking in these fourth turning outcomes. And so in our opinion, we definitely agree with you that stagflation is the most likely outcome from a longer term perspective. Now, that doesn't necessarily mean that stagflation needs to be priced in today, tomorrow, next week. And so as it relates to the sort of rising probability of a soft landing, that's been really, in our opinion, supporting this current Goldilocks top-down market regime that our models have, called for and continue to signal. The reason we're comfortable saying, because soft landing has a high and rising probability is because we don't actually care what the outcome is. As an investor, I've been coaching our clients here, 42 Macro, to get out of the camps. Don't be in the soft landing camp. Don't be in the hard landing camp. Don't be in the no landing camp. Just be in the camp that's going to allow you to make and save money for as long as you need to be in that particular camp. And right now, soft landing has the hot hand. At some point, soft landing will not have the hot hand, but if fortuitously, we have the way we've designed our quantitative risk management systems, we're going to be allowed to book gains and get out of that trade. Probably not at the very top. We don't build models and don't purport to have any real ability to build models that can pick tops and bottoms on a consistent basis. But we have built, models that help us, get the bulk of the trade, right on a consistent basis. And so we do think at some point soft landing is going to run out of impetus in terms of it being able to be priced in asset markets, but we don't think we're there yet.
Yeah, I mean, to answer the question that was asked more directly, I do think it's becoming consensus narrative, and positioning is starting to reflect that consensus narrative. The way we broadly trade these things is we have a secular view. I think if you have the right secular view for the last 25, 30 years, of monetary policy dominance and the continuation of that, you got every part of the trade right. You got growth over value right. You bet on China and expansion, globalization. We could go all down the line. Everything that happened is in line with that monetary policy dominance, pretty much. And you were a very wealthy person as a function of getting that secular view right. But did we get a correction, 2000 through 2002 of 70% in the market? Did we get a great financial crisis? Again, another, call it 70% decline in the market, 08, 09. Absolutely. You would have gotten hurt along the way if you weren't paying attention to the narrative and the positioning. The best trades throughout that period, though, are having that secular view. And when the narrative and positioning changes for people to lose faith in that, to then plod back into it, is when you really made the majority of your gains. And so, yes, you have to be, like water, like I say, very flexible and fluid. But I think losing sight of that secular reality is a major problem. That's the place where you can really, over the long run, lose a lot of money. And in particular, if you lose sight of that narrative in the context of positioning being poor, I think that's when you're potentially in the biggest risk. So, we would take, again, the other side of that trade as a function of a secular view, and the positioning now being contrary to that secular view. We believe actually this is one of the better moments to be now investing in the longer term trends like we saw in 2022. That the things that performed there are likely to come back as themes this year, now that people have had a 2023 where there was a very counter trend move to a lot of those themes.
Yeah, no, I actually don't disagree with that as well. I mean, if you go back and you look at some of the work we've done on inflation from a cyclical standpoint, because we just spent just a second talking about the secular view on inflation. From a cyclical standpoint, it's pretty clear that immaculate disinflation is going to run out at some point over the medium term. Now, what particular month is going to be the data point that causes market participants to broadly accept that reality and kind of price it in is yet to be determined. But in terms of our quantitative risk management signals, we're not expecting that data point to come over the near term. And if it does, it would be a surprise to us, at least on that front. Shifting gears to another question, our friend Danny's saying, Jim, he's been following your analysis for the past year or so. You've spoken extensively about the indices being pinned as a function of the dispersion trade. If volatility continues to be well supplied and indices are more or less pinned, do you expect the dispersion trade to persist further?
So first, I'll say, you asked the question, if it's well supplied, will that happen? The answer is yes. Now, will it? That's a different question. My view is that there is a significant amount, the primary driver of that vol compression is structured product issuance. That's not the whole reason for it, right? There's a magnification of that process through all this zero DTE trading and all the vol selling that's coming on the back of that lean. I kind of give the analogy of GameStop or, some of these meme names that, people looked under the hood and said, well, wait a second, retail's not driving this. If you look at the number, it's all funds and bigger institutions pushing this. But what people lost sight of is that retail and that concept of diamond hands being this consistent buyer and coming in every day gave a lean to institutions to continue to push price. So an entity that's consistent and a reliable on the margin probability shifter to markets then puts institutions in a place to be able to push price and then add momentum. I think this is a similar dynamic here. I think structured products are the lean that's consistent, that continues to come in and grow and drive volatility compression, which gives a advantage to vol sellers. And the vol selling itself has become significant and magnified on a daily basis by the low, the short duration of zero DTE. So I do think all the key of this is, much like with GameStop was retail, and here it is not retail, it is obviously structured product issuance and the simple demand there. What's driving that is the question, and how does that turn? And the answer there is interest rates, actually, ironically. So the lower interest rates go here, if we go into a period of recession and interest rates do decline for some measurable period of time and structured product issuance kind of declines in some meaningful way, that could actually on the margin make a significant, much bigger difference than people realize for vol supply. And given the amount of how much people are out over their skis and selling vol and assuming that it will continue, that creates potential risk for for a turn in that cycle. So we'll have to watch and see issuance and see that vol supply as we go. But and if it does remain robust, that will continue to support assets, and particularly in an election year. I think that could be very, very well be the case.
Gotcha. And sorry, just to summarize, you're saying that what's the number one driver of that remaining robust?
Structured product issuance.
That issuance, yeah. No, sorry. What was the number one driver of that issuance remaining robust?
Interest rates. So if interest rates do decline in a meaningful way, so the 10-year, honestly, it's less than 10 years, probably more the 2-year yields do decline in a meaningful way. I would expect structured product issuance to decline as well. And so, what is the Fed going to do here? And so, that's a function of path. Hard to say, right? If the market does pull back in a meaningful way and the economy does slow, you would expect shorter term interest rates to decline in a meaningful way. And if that does happen, that changes issuance dramatically. I mean, people start to go from getting 8.5% on some of these annual products, which are already down to 7.5 with the move in interest rates. Maybe goes down to 6. That's much less appealing, right? Yeah. And drives a very different dynamic.
100%. That makes a lot of sense, man. Thank you for sharing that. So keep moving in the queue here. So Brad's asking, Cem, you're saying seeing the vol increase is not measured by VIX rising. Can you explain in layman terms in terms of how the average retail person can track this increasing vol, if not by the VIX?
Yeah, so this concept of fixed strike vol is very important. The VIX, everybody's like, oh, the VIX is broken. It's not broken. It was never fixed. It was never correct. When I say correct, it's not a measure of actual pricing of volatility in the market. The market pricing for volatility and the supply and demand of volatility is a function where options and implied vol is trading. If the market declines down the skew curve because puts downside options are priced on a higher implied volatility, the market declines, but the pricing of options doesn't change at all. You naturally go to a higher VIX. You slide down the skew curve. So if practical terms, if we have a 5% decline in the market in one day, let's say, and 5% lower from here, options are priced on, let's say we're on a 15 vol here at the money, and down 5%, the options are priced on a 30 implied volatility. If we slide down and nothing changes in terms of pricing, the VIX goes from, call it a 15 to a 30. Mm-hmm. That doesn't mean there's been any increased demand. And what happens often is you get a slide down, and then the vol actually comes down. There's a bunch of vol selling, and vol compression comes in, and that implied vol goes down to 25. So the pricing of options actually decreased in that, in that view, but you'd see an increase in the VIX from 15 to 25. So it is, the VIX is a measure of current at the money or equivalent, pricing of volatility, but that volatility is already priced in along the curve. So there's already an expectation if the market declines of an increase. And so the real question is what's happening to implied volatility as a function of where it's already priced. Gotcha. And that is fixed strike vol. And that's incredibly important as an indicator of both vol supply and also what's happening broadly to volatility hedges underneath the surface.
Gotcha. And what's the current dynamics point in there?
Yeah, so right now the implied volatility of the calls, which are lower, right, is at such a low point that if we continue to push higher, they are so cheap that we have seen this, it's kind of slowed down as the market slowed down here a little bit. But if we continue to see a push higher to new highs, I would expect that implied volatility, even though that you may not see in the VIX, will actually start to go higher on a fixed strike basis. And when you see that tends to be a good indicator, okay, a vol is not as well supplied. There are buyers coming in because the vol is too low. Dealers are being taken out of their vol, and broadly it's giving a signal to people who are hedging others to come in and to be more aggressive. And that can create a dynamic that actually reflexively drives a reversal and a blow off top, and a decline in markets. But at this very moment, markets again going into expiration here, pretty placid, vols relatively well supplied. We saw a short period when the push was a little bit stronger. Again, end of year where that vol had started to go up. But again, we'll have to see as we go into this window here in Jan or Feb. We are actively looking for a push to the upside where that vol starts to increase again in a much now weaker period for the flows to actually drive a reversal. So that's what I would be looking at in the short term.
100%, man. I love your process, man, because it seems, and we try to emulate some of those things in our process as well, which is, what it's gonna look like when something changes, and you understand all the different pieces of the puzzle that they need to line up to see a big material change in asset markets. And so you're always on high alert for those particular things, as opposed to, getting pulled in one direction on this particular subject or getting pulled in another direction on that particular subject, which is what most investors are doing. We try not to do that here at 42 Macro, and obviously you guys are doing a great job for your clients at Kai Volatility as well in that regard. And then, so we got a couple more questions here to wrap up. Ted's asking, Cem, you've been, Chip.
Don't worry, I'm used to it. I've been 46 years.
I know your name, but I'm saying it inappropriately because I'm assuming they're saying it inappropriately. No, it's totally fine. So, Cem, you've been in the secular inflation camp a la the 1970s, driven by populism, et cetera. You characterize the recent disinflation as cyclical, which is fair. Ted's question is, under what circumstances would you be open to changing your secular inflation view?
Yeah, we are actively, and we have for 3 years since we've been really, talking about this publicly, looking for, and that's true for all of our processes. I don't focus on looking for affirmation of what we're doing. I'm constantly on the lookout for anything that could be contrary. And I have them in my mind what those things would be and what they are. If we see a move away from deglobalization, right? If China and the U.S. started making up and started going back to where we were, right? That would be a reason to believe that that this populist protectionist kind of trend we're on would be changing. If I started to see labor rights level out and that onshoring to kind of to stop. If I started to see politically less of a drive towards populist policy, and these are the things that are driving the inflationary picture. But the reality is, and the reason we've been able to actively, and by the way, those are all accelerating. They're not the opposite, right? And we see that year over year, and been calling for it when it wasn't even happening yet. So, the reason that we had such confidence then, and we continue to have confidence that it will be the case, is because it's generational, and these things don't change quickly. There is a whole generation that for 40 years, millennials on down, essentially, that have had a very small relative to history share of GDP, and have underperformed. At 40 up to almost 45% of the wealth creation and household formation of baby boomers at this point in their lifetime, and they feel that's unfair and unjust. You can argue whatever you feel, but historically that's accurate. And they are coming to political dominance. So every 4 years you move forward, you have a higher probability of more and more fiscal and more rebalancing to help the labor in that generation. And that comes in the form of fiscal spending and tax policy and spending for housing and for healthcare and all kinds of other things that help that group. It also drives, like I said before, protectionism, right? Because it's about labor rights and protecting, immigration and other things that come during these periods against, and exporting of jobs. And so we're starting to, we're seeing more and more of that. Those things are related. Protectionism is a function of populism. And once you start doing that, then you have more geopolitical conflict and all kinds of other commodity and resource scarcity, and everybody's starting to operate instead of a cooperative, capital-driven system looking to profit, into a protectionist populist system where everybody's competitive. And that's the framework, right? If we're looking always for clues and reasons to believe that might be turning the other way, but I have yet to not only not see that, but we've seen everything we've seen accelerate relatively quickly.
100%, man. Don't disagree with any of that. Just Colin, if you could just throw slide 74 up here on this table. It's our secular inflation model. Jim and you and I talked about this a couple times on the program before, and we just keep this thing running live. It's a nowcast effectively of the underlying trend of core PCE based on the deltas of these observed time series that have all been proven to statistically be correlated or co-integrated with that underlying trend of core PCE. So we have things like populism, productivity, wages, the wealth effect, fiscal policy, globalization or deglobalization. All those things are in this model. And the conclusion is that, on a trend basis, we should be expecting somewhere between 2.6% and 3% core PCE on a trend basis. And that doesn't sound like a lot, but it's effectively double what we experienced throughout the prior decade. And so, and obviously there's upside risk to that, given that we have not seen a particularly big pickup in commodity prices. And there's some other things that could actually cause the model to break out as well if we get money velocity back up from the lows. And it will go back up over the next couple of years, because we have to get through that big bolus of money supply that we had in 2020 and 2021 that caused money velocity to go down, but it's actually going to start to rise again in the coming years. So that 2.6 to 3% range could easily be 3.5 to 4%, and we would expect obviously asset markets to respond in kind if that were the case. All right, and then last question here from Don is asking Jim, given your secular view on inflation and populism, shouldn't Yellen be squeezing the T-bill market and using excess liquidity in markets to fund the government long term? Seems like she already missed one window of rate weakness.
Yes, I mean the answer is long term. We should have issued unlimited amounts, right, when interest rates were down at 0, right, or 1, or however you want to look at it. Unfortunately, there are other incentives here other than the long term, whether you're making the right trade in the over the long term for for the U.S. or whatnot. So there are short term thoughts here, right? She doesn't want to do a mass. I mean, if she did $10 trillion of issuance here, we'd have some political problems, right? We'd have all kinds of other issues short term. So, unfortunately, as there's lots of issues where a lot of the problems that we face are a function of short term decisions as opposed to long term, doing what's optimal long term. And because of that, we can say shit all day long, but that doesn't mean it's going to happen.
Yeah, 100%. I completely agree with you more, man. Can't agree more. Man, this has been a phenomenal conversation, man. Love your thoughts, man, your thought process. Love what you guys are doing at Kai Volatility Advisors. So my last question for every guest is my favorite question to ask every guest, which is, what's one risk management lesson that you swear by now, that you live by now, that you wish you knew at the beginning of your career?
Yeah, I think I've said several others I won't repeat what I've said in the past. I'd give a new one here is right now I think the biggest thing to do is to again try not to follow the narrative, right? Try to be very focused on as you've said, Darius, your process, and often even hindsight, looking at numbers. It's easy to buy into all kinds of narratives if you don't have a very clear forward-looking kind of process. And our process is really focused on where the rubber meets the road, and that's how you get how we don't get caught in narrative. We really look at supply and demand, and I think ever divorcing yourself of that voting machine, if you're looking at anything less than multi-year performance, will get you in trouble.
100%, my friend. Well, we got thousands of accredited investors watching us from around the world, man. So let us know how we can get in contact with you in case we want to park some capital with Kai.
KaiVolatility.com is our website. You can request a meeting, get information there. We do put out kind of news and a lot of media and content. If you can sign up to get on that list at KaiVolatility.com/news. Again, if you're on X or Twitter, at JAM _croissant, put a lot of content out there as well, and try and share the media that we do there as well.
I appreciate you, brother, man. Thank you again for joining us. This has been an excellent conversation.
I feel the same, Darius. Think the best of all your work. You really do a great job for these guys.
Thank you, man. I appreciate that, man. We'll catch you back here next month. We'll be joined by our friend Gordon Johnson over at GLG Research. So we'll catch you guys in a month. Best of luck out there. Behave and do whatever else you need to do. Signing off.